The trap of investment. The hidden signs behind high returns that can sink your money. It is around 11 at night. The soft light of a mobile screen is spreading through the room. A young investor is looking at a mutual fund performance chart on his phone. The graph is moving steadily upward. Excellent returns over the last 3 years. Everywhere, the same lines are written. Top performing fund. High return opportunity. Invest now. A strange restlessness begins inside him. His mind says, if I don't invest now, I'll miss the opportunity. But somewhere deep inside, a small voice asks, does everything that shines really turn out to be gold? The fear is that this opportunity might slip away, and the curiosity is whether making money is really this easy, or if there is a hidden truth behind this story that people usually understand too late. In reality, the most dangerous illusion in the world of investment is this, that high return is always good news. History shows that many times, extraordinary returns hide extraordinary risk. The great investor Warren Buffett often says that the first rule of investing is, don't lose money. But the shine of the market, social media posts, and the advice of friends often blur even this simple rule. That is why financial experts around the world advise people to recognize warning signals before investing. Because many times losses happen when investors make decisions by looking only at returns. If you look at the market history of the last 2 decades, you will find many such events where the temptation of high returns caused heavy losses to investors. Even before the global financial crisis of 2008, many investment products were showing excellent returns one after another. Investors felt that money was multiplying the moment they invested. But as soon as the real market picture came out, those same investments fell to less than half within a few months. This was not just the story of big investors, but of millions of ordinary people who invested without understanding the warning signs. The first warning signal in the world of investment appears when a fund or investment keeps showing unusually high returns over a long period. It sounds very attractive that a fund is delivering returns far above the market every year. But there is one basic rule of the market. It does not always move upward. Ups and downs in the market are natural. So when an investment keeps showing extraordinary performance continuously, it becomes necessary to ask, how is this even possible? Many times the reason behind this is that the fund manager is taking far too much risk. For example, if a fund is investing heavily in small and highly volatile stocks, then in the short term the returns may look huge. But the moment the market environment changes, those same stocks are usually the first to collapse. In history, there have been many such funds that showed excellent performance for a few years, but later their value fell sharply because their portfolio had become too risky. That is why experienced investors do not look only at returns. They also look at the stability of returns. If the performance chart of a fund is moving too sharply up and down, then it may be a sign that the fund strategy is extremely aggressive. In investing, stability is often more important than fast growth. Many times, an investment that grows slowly but steadily proves safer and more profitable in the long run. The second major warning signal before investing is the expense ratio. This is a term that many investors ignore, even though it directly affects their profit. Expense ratio means the fee that the fund house charges for managing your money. At first glance, it seems small, but over the long term, its impact can be very large. Suppose a fund has an expense ratio of 2%. It does not sound very high. But if you invest for a long period, that same 2% can significantly reduce your total return. Many financial studies show that over the long term, funds with lower expense ratios often give better net returns because more of the investor's money stays invested instead of going away in fees. That is exactly why passive investing index funds became popular in many countries. These funds usually have very low expense ratios. Warren Buffett has also said many times that for ordinary investors, low-cost index funds can often be a better option because their costs are lower and diversification is higher. The third warning signal is excessive portfolio turnover. This means the fund manager is buying and selling stocks too frequently. At first glance, this may look like active management, but many times it can also be a sign of an unstable strategy. When the portfolio keeps changing continuously, transaction costs rise, and in many cases, tax liability also becomes higher. Imagine that you invest in a fund where the portfolio changes completely every few months. This may mean that the fund manager is chasing short-term trends. But predicting the short-term in the market is extremely difficult. Many times, constant trading reduces returns because brokerage and other costs increase. That is why many successful investors emphasize long-term investing. Even famous fund manager Peter Lynch said that good investing often comes from patience, not from constant trading. If the turnover ratio of a fund is very high, then it becomes important to understand whether this strategy is truly sustainable or whether it is merely running after short-term gains. The fourth warning signal is the lack of diversification. In the world of investment, diversification is considered the most important rule of risk management. It means that your money should be invested across different sectors and companies, so that if one area falls, your entire portfolio does not get affected. If a large share of a fund is invested only in a few companies or only in one sector, then the risk can increase. For example, many funds invested heavily in the technology sector delivered excellent returns for some years because tech companies were growing rapidly. But when tech stocks started falling, those same funds came down sharply because their diversification was weak. Many of the world's big investors believe that diversification is the strongest safety shield for investor. Ray Dalio, the founder of one of the world's largest hedge funds, Bridgewater Associates, often says that diversification protects you from market uncertainty. If your money is spread across different assets, then a fall in one place does not damage your entire investment. The fifth warning signal, and one that is often ignored, is the frequent change of fund managers. The performance of any mutual fund depends to a great extent on the strategy of the person managing it. If managers keep changing repeatedly in a fund, then it may be a sign that there is a lack of stability within the fund house. A new manager often comes with a new strategy. This can completely change the fund's investment style. Many times, the past performance of a fund may be the result of the old manager's strategy, while the new manager may follow a completely different approach. In such a situation, investors invest by looking only at old returns, even though the future strategy has already changed. There have been many examples in investment history where, after a famous fund manager left, the performance of the fund gradually weakened. The reason was that the entire investment philosophy had changed. That is why smart investors do not look only at the fund's name, but also at who is managing it and what that person's track record is. Understanding all these signals is important because investment is not just a game of money, it is a game of decisions. Many times, people suffer losses in the market because they make decisions based on greed or fear. It feels easy to invest immediately after seeing high returns, but real wisdom lies in understanding the risk first. In truth, a successful investor is the one who is not dazzled by the shine of the market, but tries to understand the reality behind it. Before investing, it is necessary to understand the fund's strategy, cost, diversification, and management stability. These small things can protect you from major losses over the long term. If you are new to the world of investment, the best step may be to invest gradually while continuing to learn. Start with a small amount, do your research, and do not make decisions in a rush. Investment is not a race in which the one who runs fastest wins. It is a long journey in which patience, understanding, and discipline are the greatest weapons. In the end, the most important thing is this. High return is not always a guarantee of success. Many times, that very shine turns out to be the biggest illusion. Real wisdom lies in recognizing those signals before investing that point out possible danger. Because in the market, more important than making money is keeping your money safe. And perhaps this is the biggest truth in the world of investment, that real success comes to those who do not only see earning opportunities, but also recognize the warning signs of danger in time. Because many times, the biggest gain in investing is the one that saves you from a major loss.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.